You didn't buy a rental property to lose sleep at night, but if you own one in Vancouver right now, well, you probably are. Expenses are up, rents are softening, and that never vacant unit, it's just sitting there. And this isn't just frustrating, it's a financially brutal situation. And here's the part that nobody's saying out loud. Even smart, experienced landlords, they're getting squeezed. So, good properties, great locations, still struggling to make the numbers work. So no, this isn't just a rough patch, it's a shift. And if you're not adjusting, the market is going to do it for you. But there's something else happening here, a deeper shift in the fundamentals that most landlords, well, they haven't had to deal with until right now. And if you don't see it coming, you're going to be reacting too late. Because what's happening in Vancouver right now, it is not subtle, it is not temporary, and it's definitely not something that you can solve just by trying to wait it out. This is going to separate reactive landlords from the strategic ones. So in this video, I want to walk you through what's actually driving this rental market shift, not just what we're seeing in the headlines. I'm going to explain why the old strategies that landlords used to rely on, they don't work anymore. And what the smart landlords are doing right now to avoid months of vacancy or thousands of dollars in losses. And if you're a tenant watching this, there are some insights here for you as well, because this shift, it affects both sides of the table, right? You might be seeing more listings right now, fewer bidding wars, or even getting incentives to sign a lease, things that were completely unthinkable just a year ago. But make no mistake, this video is speaking directly to landlords who are ready to stop reacting and start adapting, because the landlords who understand what's really changing and then they take the right steps now, they are the ones who are going to come out stronger than ever. So for years, Vancouver landlords, they could count on strong demand. You'd list your unit, you'd get tons of inquiries in a day, and then you would pick your tenant by the weekend. But not anymore. The most recent data by CMHC, it shows that Vancouver's vacancy rate has climbed to 1.6%, the highest that it's been in nearly 20 years outside of the pandemic window. Just 2 years ago, that number was under 1%. So for a city that's used to a near zero vacancy, that is a real shift, and it's starting to hurt. And what's important here is that this is just one indicator. When vacancies rise, incentives follow. Rent growth, it slows down, holding costs, they get heavier, and suddenly those paper-thin margins that you were counting on, well, they can disappear, and they can disappear fast. And it's not just vacancy, it's pricing. In the first quarter of 2025, CMHC, they reported that advertised rents for purpose-built two-bedroom apartments in Vancouver, they dropped 4.9% year over year. Even condos, which typically hold value longer, they dropped 4.8%. And that tells you this isn't isolated to low-end rentals. The squeeze is everywhere. And if the trend continues, which I'll show you later, well, the decisions that you make in the next few months could have some serious long-term consequences. Let's talk about why this is happening, and more importantly, why it's happening right now. So first is supply. There's a wave of new purpose-built rentals that is hitting the market. Units that were approved for and financed during the low-rate boom, they are now completing, and they're flooding the system at exactly the wrong time. So these buildings, they aren't just adding inventory, they're changing the game entirely. These are high quality, well-managed, amenity-rich spaces that are pulling tenants away from older investor-owned stock, which means if your unit isn't upgraded, if your building doesn't offer tenants what they expect now, you're not just competing from behind, you're bleeding opportunity every day that it sits empty. Because in this market, tenants, well, they have options. They're comparing finishes, they're comparing amenities, pricing side by side. So if your unit feels tired or overpriced, they are going to move on, and they're going to move on very fast. And here's the real risk. even a single month of vacancy, it can wipe your margin out for the entire year. And that's why landlords who stick to last year's pricing or they ignore the shift in the tenants' expectations, they are getting crushed, and not slowly, but aggressively. And then there's the policy. The BC government, they have capped the rent increases to 3% for 2025. And already they have announced that the cap will drop in 2026 to 2.3%. So that's less than inflation in most years. Now, combine that with rising taxes, insurance premiums, maintenance costs, and you've got a situation where revenue is going to be frozen, but expenses, they just keep on climbing. That's not a manageable squeeze. That is a compounding loss, and it's not going to go away anytime soon. But there's one more factor, and this is where things get real for landlords who bought in the last few years, and that is the borrowing cost. You see, if you finance or refinance in 2020 to 2022, you probably locked in at a great rate. But now, as the terms are coming up for renewal, rates are significantly higher and monthly payments, well, they've jumped. And if your strategy was always dependent on a low rate to float you through, well, sadly, your business model, it just expired. Listen, if you're even slightly unsure whether to hold or sell, it's better to run the numbers now than to regret it later. And you can do that very easily using an online calculator. So let me show you. Okay, so here we can just go ahead and enter in the current market value of your condo. So let's just say it's $750,000 and you have an outstanding balance on your mortgage of $450,000. And we can just use the presets here for now. This is just for example purposes. Obviously, you're going to plug in whatever numbers are appropriate to you and your rental unit, okay? Monthly rent, we'll put it at $2,800. Again, you can go here and click on these different links. Those are resources which can give you an idea of what the current monthly rent should be for your home, as well as rent cap increases. Currently for the month of 2025, it's 3%. Next year, it's going to be a little bit lower. So just go ahead and plug in whatever figures are relevant to you. We'll put in a mortgage renewal year of 2026. Rental property taxes. This is all already defaulted as a calculation based on your current market value. So if you don't know exactly what it is, you can stick with these defaults just to give you an idea. Again, this calculator is really just to give you an idea of where you sit with things. But for accuracy, obviously you want to put in more accurate numbers. The more accurate, the better. Annual insurance costs, we can leave it at $600. Annual maintenance costs, so what's it take to keep your property maintained in a given year? It's usually about 0.1 to 0.3%. It defaults to 0.2%. Average amortization, we'll put on your amortization at a 25-year period. We're going to say your mortgage you're expecting to renew at, say, 4.8%. Your monthly strata is, say, $300. Rent increase, as we said, it's 3% this year. You can't go any higher, not legally, and you do not want to break the law. Alternative investment return. So here's where you can plug in what you think your money might make you in a different investment outside of real estate. Well, I guess it could be with inside real estate as well, maybe a different type of a property. But let's just say for this example, you expect you can get 4% return on something else. Now, of course, if you think you can make 10% or 20% or whatever that number is, by all means, plug it in here. Estimated selling cost, it's defaulting to 4% for the cost to sell your condo if you were to do so. That includes your agent fees, your legal fees, and your closing costs, moving fees, all of that sort of thing. And then the months of vacancy per year. So obviously when you have your place rented, it's not always rented for the full 12 months of the year. Sometimes there's a gap there where you're in between tenants. So plug in whatever number you feel is fit. We're going to put 1 month in there for now, and then click on the hold versus sell, and you'll see what it calculates for you based on the information you've plugged in. So in this particular scenario, based on what we plugged in, it's suggesting you sell the property. So it's saying the return on your investment for holding would be minus 2.9%. versus the effective ROI on your current equity. So if you put the current equity that you have in that home into something else as an investment, after your selling costs, you would expect to receive 4%. Again, that's what you put in to the calculator on the previous page, okay? So the difference, the delta is 6.9%. So something you want to consider if you're in this situation. Okay, it gives you some other numbers as well. And then, of course, like I said, down here on the side, there's some links to some different information. So if you want to look up some accurate data for these calculations, by all means, you're going to want to do so. It gives you a break-even analysis. In this situation, it's saying to match your 4% return from selling and reinvesting, you would need to charge $4,577 per month in rent. So obviously that's not going to work, not in today's market, unless you've got a really high-end condo with some special amenities and you can justify that kind of a price. But whatever your situation is, go ahead, plug the numbers into this calculator, and at least it'll give you a start, something to start with, an idea of where you sit with whether or not you should rent the unit or sell the unit. So if you want to run your numbers, I'll put a link to this calculator in the description box below. Okay, so let's dig a little bit deeper into the mortgage side of things, because this can be a ticking time bomb for a lot of people. So let's say you bought a unit in 2021 with a $650,000 mortgage at 1.89% fixed, right? So your monthly payment was roughly $2,500. At renewal in 2025, your rate jumps to 5.39%. Well, now your payment is over $3,800 a month. That's a $1,300 monthly gap. So even if you didn't overpay on the property, that kind of an increase, well, it can wipe out most of, if not all, of your cash flow. And if you're relying on rental increases to cover that gap, you're going to be stuck. But again, the rent cap is 3%. And that means that your income, well, it might rise by, say, $75 a month, while your costs, they keep climbing far faster. You've got mortgage payments that can jump hundreds of dollars when the rate renews. Strata fees, they inch up every year. And property taxes, they rarely stand still. In other words, your expenses can easily outpace that tiny rent increase, leaving you with a growing shortfall that you can't make up through higher rents. So that said, what are some of the strategies that landlords can currently explore? Well, some, first of all, are shifting to furnished short-term rentals. So they're targeting travel nurses, remote workers, or people relocating between properties. So there's definitely more management work here, yes. But in some cases, it's increasing gross revenue by as much as 15 to 30%. But fair warning here. Make sure that you check with your strata bylaws and local zonings first. Now, other landlords, they're revisiting tenant screening. So they're not just looking for financial stability, but they're also looking for the length of the lease. So in uncertain markets, reducing turnover, it becomes a real advantage. So a good tenant who stays, say, 24 months at market rent is going to be more profitable than a slightly higher rent with someone who leaves in, say, 9 months. Another strategy is to adjust your leasing flexibility by offering 9 or, say, 10 months leasing in a high demand school zone. And that way you can align with the academic year. Now, this, of course, it's a small move, but it does open your listing to a wider, more reliable tenant pool. And it's going to give you flexibility to relist in the peak seasons when demand and rents are going to be stronger. But flexibility, it doesn't just apply to how you lease, right? It also applies to how you manage your financing. And this is where I see a lot of landlords, they get caught off guard. Look, I'm saying this because I've seen far too many landlords, far too many times. The landlord, they wait until they're 60 days out from their mortgage renewal. And that is when they finally start looking at the numbers. Don't do that. Don't be that guy. Start looking 6 to 12 months out in advance. That's when you still have options. You can talk to your broker, you can run different scenarios, and you can see if there's a chance that maybe you can restructure or refinance earlier if the math makes sense. But none of that is possible if you're scrambling at the last minute. And if you run those numbers and you realize that, the cash flow is not working for you, or, the vacancy, it's becoming a real risk, it's okay to step back. It's okay to step back and reassess. That is not a failure. It's just you being strategic. For a landlord, real estate is an investment, right? And if it's not helping you build wealth or move you forward, then maybe it's time to change how you're using it. There's no trophy in holding onto a property that's draining you. It's only going to give you more stress. I always tell my clients that you don't need to have everything figured out. You just need to start asking better questions. Questions like, what would actually need to change to get the property back into a positive cash flow? Or, what is it truly worth today if I decided to sell? Not what I hope it would be worth in 5 years from now. And, could that equity be working harder for me if I was to place it somewhere else? Those are the kind of questions that are going to lead to clarity and ultimately to making confident decisions. So again, make sure you check out the calculator that I showed you earlier. There's a link below and it can help you answer some of those questions. Okay, so let's talk about what's likely going to be coming next and what it's going to mean for you. So right now, we are in the middle of a delayed impact cycle, meaning that vacancy is up, yes, but most landlords, they haven't renewed yet at those higher rates. And many new units are under construction and are still 6 to 12 months out from completion. So the full impact of today's oversupply, it hasn't even hit yet. And that means this winter and early 2026 could be the toughest squeeze yet. So if you're already feeling the pressure now, do not expect the next few months to ease up, which is why proactive decision making really matters. Doing it now and not later. So my recommendations are, first, don't chase yesterday's rent. All right, be the first to adjust, not the last. The landlords who are clinging to the peak pricing of 2022, those are the ones who are sitting empty. Second, do not wait for renewal, okay? You want to start planning now. So you might be able to blend your rate and, extend the term, maybe refinance early, or even switch to an interest-only payment for at least for a while, if that helps you keep your cash under control, right? Now, the point is that there are options, but only if you give yourself enough time that you can explore them. And third, you always want to compare the ROI of holding versus repositioning. So sometimes redeploying your equity into, a different property or even into something outside of real estate for the time period, well, it can give you a better cash flow, less stress, and more flexibility. So, just because you've owned a property for years, it doesn't mean that it still fits your goals today. Market shifts, your life shifts, and sometimes the smarter move isn't to double down. It's to step back, free up some capital, and reinvest where the numbers actually work. Now look, if you're a buyer or you're thinking about becoming one soon, this is actually one of the best times to negotiate a great deal on an investment unit. With rents softening and seller uncertainty rising, buyers who come in with a solid offer and flexible terms are getting some incredible deals. What we're seeing in Vancouver right now isn't a crash, okay? It's a reset. And with every reset, there comes opportunity. And the landlords who take this seriously, who stay curious, stay nimble, and let the numbers guide their next move, those are the ones who are going to come out ahead while everyone else is waiting around for things to go back to normal. So yeah, a lot of Vancouver landlords are getting crushed right now. But this isn't the end of the story, guys. It's a market that's telling you that something has changed. And what to do next, how you respond to that shift, that's what really matters. And listen, if you think selling an investment property is as simple as calling your agent and picking a price, Well, I hate to say it, but you might be walking straight into a trap. You see, most sellers, they miss this one thing, and it's the easiest way to leave serious money on the table. And it's what we're going to be talking about in the next video. So guys, if you have any questions about what we talked about here today and your specific situation, feel free to reach out. There is a link in the description box below. Otherwise, I will see you on the next video.